Today, the digital revolution continues. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Tomorrow, Tuesday at 8 p.m. Sydney time, I'll be joined by Adam Stokes, and we're going to discuss some of the latest developments in digital, including crypto, Bitcoin, and other issues. But I wanted today just to lay some foundations for that discussion, discussing what's called decentralized finance, or DeFi. It's called DeFi for short, and it's really an experimental form of finance that does not rely on central financial intermediaries, such as brokerages, exchanges, or banks, to offer traditional financial instruments. It instead utilizes smart contracts on blockchains, and the most common being used is Ethereum. And by the way, it used to be called open finance. So it's really an umbrella term for a variety of financial applications in cryptocurrency or blockchain geared towards disrupting financial intermediaries. And I guess you could say that DeFi draws inspiration from blockchain, the technology behind the digital currency Bitcoin. And that of course allows several entities to hold a copy of a history of transactions, meaning it isn't controlled by a single central source. And that's important because centralized systems and human gatekeepers can limit the speed and sophistication of transactions while offering users less direct control over their money. DeFi is distinct because it expands the use of blockchain from simple value transfers to more complex financial use cases. And Bitcoin and many other digital native assets stand out from legacy digital payment methods, such as, for example, those run by Visa and PayPal, in that they remove all middlemen from the transactions. So when you pay with a credit card for coffee at a cafe, a financial institution sits between you and the business to control the transaction flows and retains the authority to stop or pause it and records it in its own private ledger. With Bitcoin, those institutions are cut out of the picture. And direct purchases aren't the only type of transaction or contract overseen by big companies. Financial applications such as loans, insurance, crowdfunding, derivatives, betting, and more are also in their control. So cutting out middlemen from all kinds of transactions is one of the primary advantages of DeFi. Most applications that call themselves DeFi are built on top of Ethereum. That's the world's second largest cryptocurrency platform, which sets itself apart from the Bitcoin platform in that it's easier to use to build other types of decentralized applications beyond simple transactions. These more complex financial use cases were even highlighted by the original Ethereum white paper that was written back in 2013. This is because of Ethereum's platform for smart contracts, which automatically executes transactions if certain conditions are met. Offers, of course, much more flexibility as a result. Ethereum programming languages such as Solidarity are specifically designed for creating and deploying such smart contracts. So, for example, say a user wants his or her money to be sent to a friend next Wednesday, but only if the temperature climbs above 20 degrees. According to, let's say, weather.com, such rules can be written into a smart contract. With smart contracts at the core, dozens of DeFi applications are operating on Ethereum. And Ethereum 2, which is essentially an upgrade, gives the apps an extra boost too. And let's now go through some of the most popular types of DeFi applications. This isn't definitive, but it gives you a start. Decentralized exchanges is one of the most significant. Decentralized exchanges, or DEXs, are online exchanges that help users to exchange currencies for other currencies, whether US dollars for Bitcoin or something else. Now, DEXs are a hot type of exchange which connects users directly so they can trade cryptocurrencies with one another without trusting the intermediary with their money. Another example is stablecoins, a cryptocurrency that's tied to an asset outside of cryptocurrency, say the dollar or the euro, for example, or even gold, to stabilize the price. And cryptocurrencies, of course, often experience sharper price fluctuations than fiat, which isn't a good quality for people who want to know how much their money will be worth in a week or two. Stable coins peg cryptocurrencies to non-cryptocurrencies, such as the US dollar, in order to keep the price more under control. And as the name implies, stable coins aim to bring price stability, although often they may not. Another example is lending platforms. Now, these platforms use smart contracts to replace intermediaries such as banks that manage lending in the middle. One popular platform, Compound, allowed users to borrow cryptocurrencies or offer their own loans. Users can make money off of interest for lending out their money. And Compound sets the interest rate algorithmically. So if there's higher demand to borrow a cryptocurrency, the interest rate will be pushed higher. DeFi lending is collateral based, meaning in order to take out a loan, a user needs to put up collateral, often Ether, the token that powers Ethereum. That means users don't give out their identity or associated credit score to take out a loan, which is how normal non-DeFi loans would operate. And using Ethereum-based lending apps, as mentioned above, means that users can generate passive income by loaning out their money and generating interest from the loans. Something else to discover is wrapped Bitcoins, or WBTC, which is a way of sending Bitcoin to the Ethereum network so the Bitcoin can be used directly in Ethereum's DeFi system. And the wrapped Bitcoin system allows users to earn interest on the Bitcoin they lend out via the decentralized lending platforms, which we've described already. Something else to think about is something called prediction markets, which are markets for betting on the outcomes of future events, such as elections. The goal of DeFi versions of prediction markets is to offer the same functionality, but without intermediaries being involved, which is where they are in the real world. Though prediction markets can sometimes better predict outcomes than conventional methods like polling. Centralized prediction markets with good track records in this regard include InTrade and Predicted. DeFi has the potential to boost interest in prediction markets since they are traditionally frowned upon by governments and often shut down when run in a centralized manner. And in addition to these apps, new DeFi concepts which are springing up include yield farming, which is really for knowledgeable traders who are willing to take on risks, where users scan through various DeFi tokens in the search of opportunities for larger returns. Yield farming has the potential for even greater returns, but of course, greater risk. And these systems also tend to be complex and often lack transparency. And there's something else called liquidity mining, when DeFi applications entice users to use their platform by giving them free tokens. And this has been some of the most fizzing forms of yield farming yet. And there's something else called composability, where DeFi apps are open source, meaning the code behind them is public for anyone to view. As such, those apps can be used to compose new apps with the code as building blocks. And finally, there's money Legos, which is putting the concept of composability another way, where DeFi apps are like Legos, the toy blocks children click together to construct buildings, vehicles, and so on. DeFi apps can be similarly snapped together like money Lego to build new financial products. So the question to ask is investing in DeFi safe? No, it's extremely risky. Many believe DeFi is the future of finance and that investing in the disruptive technology early could lead to a massive gains, but it's difficult for newcomers to separate the good projects from the bad, and there's been plenty of bad. As DeFi has increased in activity and popularity last year, many DeFi applications, such as memcoin YAM, have crashed and burned, sending the market capitalization from $60 million to zero in, wait for it, 35 minutes. Other DeFi products include Hotdog and Pizza face the same fate, and many investors lost a lot of money. And in addition, DeFi bugs are unfortunately still very common. Smart contracts are powerful, but they can't be changed once the rules are baked into the protocol, which often makes bugs permanent and thus increases risk. And I suppose the last question to consider is, will DeFi go mainstream? Well, while more and more people are being drawn to these DeFi applications, it's hard to say where they'll go. Many of that depends on who finds them useful and why. Many believe various DeFi projects have the potential to become the next Robinhood, drawing in hordes of new users by making financial applications more inclusive and open to those who don't traditionally have access to such platforms. But this financial technology is very new, it's very experimental, and it isn't without problems, especially with regard to security and stability. Now, it's just worth pausing and looking at the total value that's been locked into DeFi. It's around $41 billion as at today. And interestingly, if you go down the list on DeFi Pulse, which is one of the definitive sources of information about what's going on in the DeFi sector, you can see there that at the top of the list there is Maker, which is a lending category with 6.95 billion locked away, and then a couple of other lending platforms below that. Then some digital exchanges, some derivatives, and various other flavors. As you go down the list, you can see that the value locked in drops very quickly. And in fact, some of them towards the bottom of the list, and I'd make the point that this is not definitive in terms of everything that's out there, is very, very limited indeed. And so that's as far as I'm going to take the discussion at the moment. But I think the takeaways are these, that relative to the 1 trillion plus in Bitcoin, DeFis are still very, very immature. They are evolving fast, and if you're an optimist, you might suggest that they actually could end up decentralized and therefore removing banks altogether, because individuals would be able to lend money, deposit money, and do other transactions without any intermediaries. However, of course, regulators may have something to say about that, as well as governments. I guess the other angle is to simply say that there is still so much risk here that you would really only be speculating. And some people are happy to speculate, and given where the rest of the markets are at the moment, maybe that's just an extension of the broader degrees of speculation that there are. Anyway, I'm hoping that we'll be able to take this conversation further tomorrow, so join me then with Adam Stokes as we discuss the evolution of digital. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.